Hi, I'm Clarke, Head of European Fixed Income Strategy here at Scotiabank. The most striking consequence of the Brexit vote so far has been the gyration in inflation. The pound exchange rate dived in the immediate aftermath of the vote, pushing up the cost of imported goods. This had far-reaching consequences, affecting economic growth, wages, how well off people feel, and the outlook for interest rates. But the big news so far this year is the surge in prices associated with the squeeze in household living standards is going away far more quickly than most people had assumed. However, it appears the market's still expecting rates to rise this year. That might sound quite strange given a backdrop of lowering inflation and amid some sluggish economic data, including near-zero economic growth during the first 3 months of this year. Conventional wisdom is that the bank tends to cut rates, not hike them, when the CPI is lower than expected. But there are different kinds of inflation. Exchange rate sensitive components of inflation, like package holidays and clothing, drove the CPI higher last year, and it's these same components that are behind the slowdown in inflation right now. The Bank of England can't really control this kind of inflation and can afford to look through it. What the BOE can control is domestically generated inflation. Domestic price pressures, such as service prices, were muted last year, helping the bank to look through the spike in overall inflation and resisting tightening interest rates until very late in the year. Right now, we're seeing signs of faster domestically generated inflation, like higher wages. The bank cares much more about these signals and can therefore hike rates despite falling overall CPI. Last but not least, it's never been about current inflation. The bank can only really affect inflation on a 1 to 2 year horizon, with precious little slack in the economy and scope for inflation to be rising 18 to 24 months from now. They can also look through falling current inflation. So what will the Bank of England do next? Market expectations for Bank of England interest rates have been all over the place in recent months. At one point, the market had priced in a 90% chance of an interest rate hike at the May 10th meeting. We saw those expectations evaporate, and the committee ultimately left interest rates at a lowly 0.5%. We had some weakness in the economic data at the start of this year, which contributed to that pause in hiking rates. However, that's been largely due to adverse weather conditions, the effect of which should prove transitory. Given this, the lack of economic slack, and signs of rising domestically generated inflation, we expect the Bank of England to raise interest rates at the August meeting. You can find more in-depth analysis and thought-leading content from Scotiabank on our website, and you can also follow us on Twitter @ScotiabankGBM. I'm Clarke. Thanks for watching.